Today, we're going to talk about how to find the best sector to invest in on the market. We're going to talk about how to identify what the top performing sectors on the market are. Then we're going to talk about the worst performing sectors. But most importantly, we're going to look at sectors that are emerging from a weakened position into a strengthening position. At the end of this video, I'm then going to give you my pick as the top performing sector going forward for at least the next few months, insofar as what the sector charts are telling us today. My name is Keith Richards. I'm a technical analyst, president, and chief portfolio manager at Value Trend Wealth Management. Let's get started. Okay, so for those of you who are familiar with my videos, first of all, you'll notice that I'm still on the couch. My office is still being renovated, so we got that out of the way. The next thing we're going to talk about is I'm going to use a sector rotation graph that is a little different than the graph that I have used on past videos and blogs. And by the way, if you don't follow my blog, it's at www.valuetrend.ca. And it's published once or twice a week, and it covers a lot of charts and graph, and it actually covers ideas that are not covered here on the videos. How come? That's because it's actually easier for me to write a blog than it is to record a video. So I record a lot more blogs with ideas, and I try to bring the ideas that require a little bit more explanation to the videos like today's. So let's talk about a sector rotation graph that's a little different that I've used in the past. It gives you the same information. I'm using the same parameters, but some of you who have seen my normal sector rotation graphs, which are normal bar graphs, will be kind of surprised at the way these rotation graphs look. So let's take a look. This is the S&P 500 past 2 months. So this is 2 months worth of rotation, and I always work with 2 months. And again, you can take my online trading course and you'll understand why I use 2 months. But what I'm trying to do is identify the top performing sectors, the current top performers, and then I'm trying to also identify what are the worst performers. But most importantly, I want to find what are the emerging performers. So let's take a look really quickly. You can see I've already given you the hints at the top. Utilities, staples, materials, and industrials are the four I really want to talk about. But just to cover a few, the staples, which is XLP, have been the top performing sector for the past couple of months. But you can see there is a bit of a move to the downside. So that can tell us that maybe the reign of the staples is coming to an end. There's no concrete proof to that, but it's something we should keep an eye on, which is why, again, another one of the reasons why I do this every 2 months. I constantly want to see where's the rotation. So if I saw this move way down to here, I know that I got to get out because it's a declining trend in strength. So this isn't actual chart performance. This is momentum. Okay. So next thing, utilities. Utilities have been a very strong sector in the past 2 months. Why? Again, like staples, it's a defensive sector. Everybody's been scared. Market's been going down. People go to safety. Utilities and staples are considered safe. Okay. A couple of other sectors that we are going to take a look at right now. I put X's beside. You'll see that real estate, XLRE, banks, financial, I should say, which is XLF, energy, which is a sector I have liked over the past couple months, and I was correct. It moved from an improving into a leading and now declining in strength sector, but it had its play. And then finally, industrials. Now, the two things I want to I should also point out base materials. So the two I'm going to focus on today are base materials and industrials. So these two here. Now, you might wonder, what are these tails? Well, that's really just a track record of where the sector was. So if we're looking at this, which is XLRE, the real estate, you can see it went from an improving momentum and it kept climbing and climbing and finally began to arc down. So you get a bit of a history by following these kind of charts. They're on stock charts. They're called RRG charts. problem is they can look a little messy, as you can see. A couple things I want to show you as well, like not only is the financial sector declining, but the communications sector is also declining in strength. So those are two sectors we probably don't want to be so interested in right now. In the penalty box, we have consumer discretionary. So we talked about consumer staples. That's the stuff you need, toiletries and whatnot. Then there's discretionary. There's that new Cartier watch you always wanted. Well, you're not going to probably buy it now because we're in a recession. So discretionaries, that could be a new couch, whatever. And then, of course, technology, which has been in the doghouse for at least 3 or 4 months. A new one I also wanted to talk about. The problem with these charts, as I said, they've got these big long tails, and it covers the lagging, where that word is lagging. And this ticker is, I believe it's XTN, if I'm not mistaken. It's the S&P transportation sector. And you can see, if you could pick the worst possible sector to own right now, it's been the transports. We're going to talk a little bit about that and the reasonings behind that in a minute. But let's just take from this chart that what we should be focusing on is the two emerging sectors, which are industrials and base materials. Okay, just a quick word on the transportation sector. It's an economically sensitive sector. And remember, you saw the banks and communication sectors declining from a positive strength into a weakening strength momentum. Well, that's because banks in particular are very economically sensitive. Well, transports are very economically sensitive. That's because if nobody's buying anything, there's less goods to move. I mean, if we really came down to it. So we can look at the individual stocks. FedEx down 21%. The Jets airline ETF down 25%, and Old Dominion Trucking, which is a big trucking institute, down 27%. You could see, the decline has been like a brick. And unlike if you looked at a chart of the S&P, which has also fallen, but it's really not recovering. If we see it's had a very, very tiny recovery, and nothing like the S&Ps, and the decline was quite parabolic. So what I'm saying here is that at this point, the transports are telling us that a recession is coming, if not already here. And interestingly, this is all US stuff, but from a Canadian perspective, I opened up my financial news this morning, and there was some news about Canadian recession is basically being confirmed. Okay, more proof on that, by the way. I just thought I'd show you an interesting chart that I saw the other day from Bloomberg, and that is that the GDP growth consensus for the year 2025. Well, I think this chart is fairly self-explanatory, isn't it? The growth forecast is falling like a brick. So my two emerging sector charts are the industrials and the base materials. So let's first look at the industrials, and you can see that there's been a decent pickup. In fact, on a relative basis to the S&P 500, it's actually picked up at a stronger pace than the S&P has, even in its rally. So there is some hope here. From a technical perspective, I would want to see this downtrend break. It hasn't broken yet, but we should definitely keep our minds and eyes on the industrial sector. Just one other sector rotation chart I wanted to show you, just because most of my viewers are Canadian. There's less sectors in Canada to follow, but this is the sector rotation chart for Canada. And what you'll see is that it's the same leading sectors as in the US, or at least it has been. And, some of them are starting to round over, but it's staples, utilities, and materials. And the lagging sectors are just like in the States, it's discretionaries and technology. So now I want to talk about a subsector of the materials, and that is copper. And copper plays into a theme that I view as a longer term theme. And in fact, I'm going to quote some research from Morgan Stanley, and Morgan Stanley is doing some projections out to 2050. So robotics is going to be one of those very long lasting sectors that you want to be looking at, because there's a lot of moving parts that surrounds robotics that you can make a lot of money on in the near term and long term, especially as investors begin to pick up on the idea, and the material costs and material goods to make these robotics start to come into focus by the markets. So Morgan Stanley did a global humanized model, and they project 1 billion, with a B, robots by the year 2050. So what they were saying is that the implications for global manufacturing supply chains and geopolitics are still underappreciated. And one example of that is, and this now comes from some research I took off of Bear Traps, is that it takes 90 kilograms approximately of copper alone. Forget aluminum and steel and whatnot, but just copper. Apparently the average robot takes 90 kilograms of copper through the electronics, the motors, and stuff like that. So 1 billion robots with 90 kilograms of copper per robot, and you got to figure that's an awful lot of copper that's going to be used beyond the normal uses of copper for cars and wiring your house and every other thing, including the use for AI, by the way, which isn't even included in this calculation. So there's an awful lot of copper usage. I didn't do the math, but there's an awful lot of copper usage that's going to come above the use that we already have for copper. And by the way, the current usage, mining of copper and usage of copper per year lies somewhere around 22 million tons per year. Okay, so we're using about 22 million metric tons per year of copper. The estimated reserves, again, this coming from Bear Traps, is something like 870 million tons. So you're going to probably have some point in the next 30 years where the demand for copper is exceeding the ability to pull it out of the ground and find it. And so the argument can be made that copper and other base metals that are used in all this AI and robotic stuff may become much more expensive over time. And so for those of us who are buying into the sector now, even if we don't see tons of action in the near term, we will probably see lots and lots of action over the next 5 to 10 years. So let's take a look at some charts. This is the base metals chart. So you'll notice I'm concentrating on the metals. I'm not focusing on any of the other materials. So the base metals, and I've probably shown this chart. In fact, I know I've shown this chart on these videos before. They've been trapped since basically 2022 in a trading range. As far as I'm concerned, the base metals, I have been swing trading them. You can buy somewhere into the bottom of the range, sell somewhere into the top of the range. Eventually, based on what we're talking about today with robotics and AI and all that stuff, I would be absolutely flabbergasted if they did not break out within the next 3 years. In fact, probably sooner than that. But in the meantime, it's just coming off of the bottom. I think this is trading for dummies, and you just don't get greedy and you play it until you think it's run out of steam, and then you try to sell it somewhere up here. It's not a recommendation because you got to do your own research, but there's obviously a pattern here, and it's, I think, a high probability trade. Next thing we're going to do is we're going to take a zoom through the metals, and we're going to look at one particular metal, copper, that we were just speaking about. So let's take a look at that chart. Not quite as neat and tidy as the overall base metals chart, but you can see that it has been on a slight uptrend with a lid. So the lid on the copper price itself is around $5, give or take, but it's had an increasing or climbing set higher highs and flat highs, but higher lows. And sometimes we call that a triangle formation. I just call it a long-term consolidation, and sooner or later that will break out. And that means good news for investors if it breaks out. We've seen copper, so we looked at the metals and they were still near the bottom of their range, but copper is getting right close to that $5 point. It's at $4.81 or something as I look in this chart. So I think that copper will possibly break out sooner rather than later, but I won't be buying it as an individual commodity until it breaks out. The other thing you can do is look at copper mining stocks. There's lots of them out there, but I like buying producers more than I like buying commodities most of the time because I can hang on to them for a little bit longer and I don't have to worry about all the the futures contracts and that kind of thing when we buy an ETF, for example, surrounding a commodity. And playing the futures markets is another game that I don't get involved with as a portfolio manager for my clients. So we do usually buy the producers. So you can probably do your own research research and find lots of good quality copper producers if you buy into this argument that it's maybe not a short-term play, but it's probably a great longer-term play. And if it breaks out, it's going to be a powerful play. Final chart is something I mentioned on my blog, which again is why I'm always pointing you towards my blog at valuetrend.ca. You should subscribe. You get it in your email every week. And basically, I was talking about that Trump has been talking about tariffs with China. And one of the statements that came out of Trump's office, it wasn't Trump that said it, that they said, well, we can produce our own materials here in America. Well, that's absolutely not true with the what's called rare earths. So China makes something like, or produces, I should say, something like 80% of rare earth metals of the entire world. They're responsible for producing about 80% of that. So it stands to reason that there's going to be a deal with China simply because of that need, because, you know, all this AI stuff and whatnot cannot be done without these rare earth metals, and China is, as somebody called it, the OPEC of rare earth metals. So I'm going to take a look at the two probably most probable metals within the rare earth segment. I mean, beyond lithium and all that, which is for batteries, but I think battery technology is rapidly changing, and lithium batteries are probably going to go by the wayside pretty soon, which is very distressing when I saw the Honda plant go up in Ontario, but we won't get into that because it's really going to turn to solid state and that kind of thing. But for the rest of robotics and AI, palladium and platinum are very, very needed within the production of this new technology. Again, this is longer term outlook, because as Morgan Stanley said, this stuff isn't really going to be, you know, at its peak for another 25 years. So we're at early stage and we're looking at that stuff. And that's why there's been this big base on the platinum and palladium. This is the Sprott ETF. It's SPPP. It hasn't broken out. So for now, it's a swing trade. You try to buy at the bottom, you sell at the top, which is fine. I mean, you can make money doing that. But I'm going to tell you that if and when, I should just say when, because it's pretty obvious that there's going to be a need for these materials. So when that happens, the breakout would be powerful, because there's really so many points that it could get to. It could end up being more than a double within no time. That hasn't happened. So I'm not saying this is going to double overnight. What I am saying is that in the meantime, it's not a bad swing trade, and a breakout is probable because of the fundamentals behind the need for base metals, materials, rare earth, that kind of thing. I hope this helped, because we started off with a sector rotation model and we saw the rotation happening. We dug down a little bit and we looked at sort of the closer look of the sectors that I like in particular. So I hope that helps. And final note is that I want to pass a word of appreciation for all the viewers who responded on my gold video that I just did, where we talked about the day in the life video, and the response was overwhelming. So thank you very much, and we'll see you next week. Hey, thanks for watching. I hope you got value out of this episode. Please like and subscribe below. We're trying to grow the channel, and it would really be doing us a big favor. I'm presenting ideas every week on trades that we're actually looking at Value Trend. And by the way, I don't just talk the talk. I walk the walk. I have been a portfolio manager for 35 years. And in fact, I was one of the very early pioneers in technical analysis here in Canada. On my website, valuetrend.ca, you will see a link for our online trading course. And this course is a complete money management system. I do encourage you to take a good look at that and consider taking it. I priced it extremely low because I want retail investors, that's you, to take the course and get value out of it. It's literally my 30 plus years of experience put into one complete step-by-step course. And honestly, I wish that I had had something like this when I was an early investor. It really will stop you from making so many mistakes. I also suggest you subscribe to our Never Miss an Opportunity program, which is our blog and our newsletter. There, you're going to get ongoing ideas, tons of charts, lots of trading ideas. And by the way, we never, ever solicit. We don't send you junk spam and stuff like that to try to get your business. It's for information, because part of my passion is to teach retail investors how to invest properly. I've been doing this, as I said, for 35 years, and I hope that I'm able to pass on some of the things that I've learned through this career as both a pioneer in technical analysis in Canada and a long-time portfolio manager. Thanks for watching. Don't forget, push like, push subscribe. See you next time.